Hello traders, it is 12:04 p.m. Chicago time on Thursday, the 3rd of September, 2020. Thanks for joining me today. We're having a study hall and we're doing it during a very large market move today. The NASDAQ is down 5.5% almost, 660 points. So it's difficult. I know it's difficult for everyone to focus. I wish I could easily reschedule this, but I cannot. So we're going to push forward. I want to remind you that derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. Today's topic is money management in practice. It's very timely, believe it or not, for today's market environment. And the goal with today's talk is really to address some of the things that maybe some of you are struggling with on a day like today, where the market is moving a lot. So what are we going to cover today? We're going to just talk in general about what money management is. There are different concepts of it, depending on whether you're an investor and so on. And some people kind of use the term wrong, in my opinion. Aspects of money management and trading. Is the concept defensive or offensive? Why are we doing this? Is this something that's going to is really going to optimize your edge or whatever, or is it more of a defensive thing? Let's look at sizing versus price versus trade management using a rigged coin to trade with. So I'm going to go through these concepts, and my goal today is to talk through this very quickly and get us out of here quite rapidly, because again, even though it's noon here in Chicago, the market's moving around, and everybody probably wants to get back to the markets. So what is trade management? The goal for trade management in general is to optimize bet sizing for risk. So the goal here is to take into account a few variables to size our trades for the optimum use of equity while maintaining a low risk of ruin, or a probability of basically blowing out. And this is a concept that's kind of ignored by most, because until recently you had to trade a minimum of a 1 E-mini or something in the futures, and that's all people could trade. And it's current the margin on an E-mini is probably going to increase today, since we're below 3 vol sigma close to close. But most people kind of ignored the money management concept because they just traded their one lot, and that's all they can do. They can't resize. But the variables that go into it is, how big is your account? What is the probability of a lost streak that would lead to a ruin? In other words, I put on 10 trades and I hit 10 out of 10 losses. What does that account for in my account size? Our personal risk tolerance, the volatility of the product that we're trading. Going into a DAX is going to have a very different sizing algorithm than going into, say, a euro dollar that or a 2-year note or something that will move very slowly. Contract size, the general tick value of the product, and of course your cost is a factor as well. So those are the pieces that go into money management. And what we're going to do is layer something else, which is more important, that I'll get into here. So first, aspects of money management. Most often, money management refers to quantity sizing. Equally important is trade management and risk factor. Once we know how much to trade, the crucial piece is what? What is the crucial piece once we know how much to trade? What do you think is the most important thing that we need to figure out once we know what size we need to trade? Anybody? Are they
Crickets.
just blowing you up with answers, Yoda?
Crickets. Risk to reward. Risk are the
Right.
two
Risk
answers.
reward is the next thing. It's sizing the trade management for that. The concept of money management is really defensive. Money management is a subtopic of our risk management plan. It falls under our risk management plan, and our risk management plan tells us what our loss limits are for the trade, for the day, for the week, for the month, before we have to stop. And money management's that component that tells us how much or how little we can trade. To if we hit those losses. Without a thoughtful approach, the probabilities are abysmal when it comes to the money management uh, plan. It really, you don't have a chance, a snowball's chance in hell if all you're worried about is what the trade setup is and what your charts look like and when you should trade. If you have not given much thought to the risk side, specifically the money management, the trade management side, it is really difficult to make it. Let's look at sizing versus price versus trade management. A properly sized trading streak doesn't give us an edge. So if I just focus on trade sizing alone, hey, I'm going to trade 2 lots in the micro ES. If I look at that alone, that doesn't give me an edge. I still need, it's important, but I still need an edge. Without properly sizing our edge, without proper sizing though, our edge is going to struggle as well. So these two things kind of have to play with each other, have to go hand in hand. This is the yin and yang a little bit. While many focus on the optimum price or entry, sizing exceeds price in importance, and trade management exceeds both. I'm going to say this again. In fact, I'm going to bold it. While many focus on the optimum price, hey, where did you get in there? Hey, why did you get in at that price? Or entry, sizing exceeds price in importance. I've got to get my sizing right before I figure out what my setup is. And then more importantly than sizing and price, I need to get my trade management right. Because if I have poor trade management, if I take a tick winner and put in a 100-point stop, I'm not going anywhere either. If I go and figure out that I can only trade 2 lots, but I don't have a plan for when to trade, then I'm not going to have that great a chance either. But most will focus on price, and then you get your sizing in there, but unless you figure out the trade management that layers on top of it, that's the piece, that's the throttle that gets us moving, then we don't have it right. So a subset of money management is actually trade management, and this is the component that I'm focused on today. Trade management is the process of sizing our actions after the trade is on. Okay, so I'm going to quickly look at the coin toss exercise to very roughly validate the ideas here. So what I've done, and some of you may be familiar with this, what I've done is I've gone and created a 4-phase program to validate the idea for you. And here's the program, okay? The program is, and you'll note a couple things. There's a sizing component, there's a trade management component, and there's a money management component, meaning risk and trade management, but there isn't a price component. And the reason there isn't a price component is because I'm taking that one piece and I'm making it random. And I'm doing so in the market. So what I've done is I've created a scheme where, and really I can't overemphasize the importance of this. I've created multiple trade management plans with the same edge, and the edge is that it's a coin toss. It's random. That's the signal. The setup is all of it's random. The first phase in the MNQ is trading a 1 lot with a 10-tick stop and a 10-tick target. Now that's very, very tight for the NQ, and the reason I made it that way is because the NQ, we have almost an equal chance, because it's so thin, we have an almost equal chance of getting our stop versus our target here. Okay, so we're not concerned about rotation sizes and optimum stop sizing for the periodicity that we're trading or the time frame we're trading, all that stuff. We're not interested in that at all. We're just looking at the concept of setting up trades of different trade management schemes, and we're placing them randomly, and we are really just following a plan. Okay, so I'll show you my exact entry signal. Let's see if anybody's awake. Are you interested in seeing what my entry signal is? It's very sophisticated.
Everybody's saying yes.
Good.
Oh,
I
there's
just want to
one
make
no.
sure you're awake. There it is. You just go to Google and say coin toss, and then you flip. Okay. You get stopped out, you get your target, you flip again. You get stopped out, you get your target, you flip again. Okay. Heads are longs, tails are shorts. So this next trade, we're going short at market. Filled and closed, short again at market. Filled and closed, long at market. Filled and closed, long at market. That's our edge. Okay. So many of you will probably automatically assume that because it's a fair coin or a randomizer, not sure how fair Google is, but because it's a coin, you assume that the win rate is 50% because it's easy to conflate the outcome of a fair coin, the edge of a fair coin, with the edge in the market of using a fair coin. And it's definitely not 50%, although it can be close to it depending on the money management scheme and what the market skew is. So this is a variable piece, okay? But it's not 50%. And we'll look at the details there. So this is what I'm talking about here is something that Yoda and many veterans of being around me are aware of. This coin toss exercise is the most important and the first exercise that prop traders will do for a long period of time. They sit there and they just flip a coin, and they do it in a simulator, and then they move on to other exercises. And the concept we're looking at here is how the market responds to randomness, because the market ultimately, the outcome of every trade is random, and that's the point we're trying to instill. But that's not today's exercise. Today's exercise is talking about sizing. So phase one, we have a 10 tick stop, 10 tick target, which is really nothing for the NASDAQ. Okay, under this scheme, there is no partial. Should remove that, and you just get a 1R risk factor. Okay, so risk reward is 1. Okay, so if we get filled full, we make 10. And this also doesn't exist. If we get filled, we get 10. If we lose 10 ticks, and that's it. Scenario 2, we're trading 2 with a stop at 10, but we're going to take our risk off the table relatively quickly at 5. And then we have a target on the second for 10. If we get filled partially, meaning we get 2 lots, and then we get a scale out, we get stopped on the second, we have a 0.5R. And if we get a scale out and a target, we get a 0.75R, because ultimately we can only make 15 ticks, but we're still risking 20 ticks, 2 times 10 on a full stop. And we're always looking at the risk factor for the full stop on the whole trade. The phase 3 is more of what I do and more of what we talk about a lot, what that micros, that kind of sample plan that we gave you for the micros of 3 lot, it fits this scenario phase 3. Phase 3 says we get in with 2, we stop for 10, we scale out 9 as close to the risk as we can, but a little bit less of it, almost like we're taking rotations into account. And then we're shooting for a target of 14. And in that case, if we get filled 1 and stop, we have a 0.9 R, which is still lower than 1, not good, but this is on a partial. If we get a full fill, we go to 1.15 R, okay? And then the final scheme is it's a 1 lot and we are risking 10, taking 15, a 1.5 R, okay? So these are the trades. These are the trades. Here's the view of all of the trades. This is on the EdgeWatch app, which we're releasing here soon to Convergent members on Rhythmic. And what this does is it kind of gives you a breakdown of what's going on, the overall metrics. So this is the first day of me doing this. This was maybe Tuesday or Monday, I don't remember. 120 trades, 4 phases of 30 each. So I took 30 samples of each phase, and this is what it did. It went long 55% of the time, short 45% of the time, and the aggregate, this doesn't tell us much about the different phases. The aggregate, we get these results. What I did is I took 120 more trades, so I have a sample of 60 because 30 is too low. Took a sample of 60, and I put them into a spreadsheet and computed what these are. So what you want to pay attention to is these numbers right here. So these are the numbers you want to kind of pay attention to because the other numbers are sort of let's color it this. These come off of the platform, and of course they mix all that stuff up. So here's phase 1, and again, phase 1 is 10 tick loss, 10 tick target for 1 hour, okay? And phase 1, you can see the first trade got $5, and then you could see that the expectancy with every loss, 100% and 50-50, then we get these losses and it starts to drop. But at the end of the day, at 60 trades on the 61st row here, at 60 trades, that's the sample size, it's about break even. This is on live market data at some point in the day. So you can see this is kind of the IB, the end of the IB period. And it came out at the 0.07 on 52% win rate, 48% loss rate with a 48% stop out. These will equal each other because it's a 1 lot. Okay, so on a 1-to-1, yeah, this does not include costs. This is just purely, we're not interested in cost at the moment. We're just looking at trade management purely. Cost factors into the actual equation, but this is purely on P&L. Okay, so a risk factor of 1 brings us back, and about 60 trades brings us back to 0.07 expectancy. Next, we run the same experiment. This time, we're taking 2 lots, 10 tick stop, 5 tick scale, 10 tick target for a full R factor of 0.75. And this is how it runs. We got the full fill here, $7.50. It's as good as it gets on the upside. We either gain 7.5 or lose 11. And you could see that the numbers just really struggle. We end up losing $67 overall. And even though our win-loss is 50-50, we end up being at a loss, and our full stop is at 43%, which is kind of high. Okay, this is high if in real life my full stop out rate's 43%. Something's wrong with the way I'm sizing the trade. So this is that two lot 10 tick stop on the MNQ with a 5 tick scale 10 tick target for a 0.75 R a scheme, trade management scheme. Scenario 3, if you recall, this is as close as to what the way I trade and the way I suggest traders day trade, this is for day trading. Scenario 3, 2 lots, 10 tick stop on the 2, 9 tick scale, and 14 tick target for either a 0.9 or 1.15 R return. And so it starts out pretty good, right? Lucky flips. Looks like short, then long, 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 short, 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 and so on, regardless of what the market is doing. And as we run through the trades, we see that, you know, it's not too bad staying in the yellow. And we finished the day on random entries. We finished the day on a plus 0.74 expectancy, 75 cents per trade. That's the expectancy here. And then finally, we have this one lot, 10 tick stop, 15 tick target, run on the MNQ on random flips with a 1.5 risk factor. Remember, we're not really trying to make money here. This is an exercise in looking at the impact of how we size our trades and our money management in general, which is the point of the study hall, right? On phase 4 with a 15 tick target, 10 tick stop on a one lot, we start off pretty good. We've got a streak of wins, pretty decent. And then we get into negative territory here, start taking losses. We get into negative territory. It's a one on, one off. So the loss percent and the full stop percent are the same. And we finish at 0. At the end of the day, we ended up finishing at 0. This phase is interesting because it doesn't give us a chance to secure risk or to fund the trade or finance the trade or whatever you want to call it. It doesn't give us a chance at a scale out. It is binary. You're either going to get your 15 ticks or your 10 ticks, which is hard, right? In real life, trading one lot is harder than trading multiple contracts. But still, because of the way we size the risk in this trade, we end up at 0. This is not planned. At 30, at a sample of 30, right here, row 31, so the 30th sample, we're still doing pretty good. We've lost 15 cents per trade. Not too bad, not too bad. And the thing that is saving us from really puking out is what? What is the thing? It's not our entry plan. It's not our edge. It's not our money management sizing versus our account size versus rotations versus all that cool stuff. What is really impacting the fact that this one lot ended up not straying too far? What is the point? Tell me you
You
got the
have
point.
you have stop loss, you have reward greater than risk, you have profit factor per trade, you have RR skewed to the target, consistency 1.5 to 1, large sample size.
Okay, so the sample size is important because you can't get a 50-50 coin flip on 3 flips. It's not going to happen. The coin's not going to stop on its edge. So that's important. Let's grant that. It's the factor. It's the R factor. It's the sizing. It's the sizing of risk versus the stop. The stop versus the reward. That's really making a point. That's really making a difference here. So if we look at the equity curve, orange being the phase 1, that's the one lot, 10 and 10. Blue being phase 2, which is 2 lot, 5 and 10 versus a 10 tick stop on a 2 lot. See, that's the profit factor on it was 0.75, right? Let's refresh, 0.75. So phase 1, 1.0. Phase 2, 0.75. Phase 3, 1.15 on a full fill. Phase 4, 1.5. Here are the equity curves. I know this isn't a huge sample size like we did with the risk management webinar in the key webinars section of your trader dashboard on our website. It's a small sample size, but this is really a stark and very fresh example of how this works, right? So, and I'm tracking it with the EdgeWatch app to make sure that what I'm seeing here is true. And it's, you can't deny that this thing it does make a difference, right? So as we look at this, and let me pull up the other images that I took. Come on, this Photos app in Windows is pretty terrible. This is on the 1-day sample. You could see that the risk factor, the win-loss ratio is kind of hovering around 50-50, with a full stop also hovering at 50-50. And so this is what I would do with the trader's performance. This is how we look at the trader's performance. This, of course, did not have enough samples here for it to tell us much. This is the total P&L kind of shifting between the zero, negative and zero. Really, these I guess these don't provide that much perspective, but this does. And what this is saying is when your R factor on the way you're managing a trade is less than 1, it's really difficult to overcome randomness, which is our goal. That's our goal, because the outcome's always random. So this should be making an impact on you. Looking at the expectancy, the expectancy is always really high or really low at the beginning because it's an average, and then you start to wind in, and you can see the expectancy for phase 3. Reminder, phase 3 is as close to what we talk about as we can get it. It's a scale out that is about proportional to the stop, with a reasonable scale out outside of that. 9 ticks versus 10 stop, 14 ticks versus 10 stop, giving us a profit factor or a risk factor that is just over 1 R. Just over 1 R. We're not looking for 2 R. We're not looking for those guys who I think are just have to be real aces that go out there and get 10 R, or investment programs that get 20 R with a win rate at 28%, but still profitable. Like I couldn't trade that way, just loss after loss after loss, and waiting for that big one to make up for all these losses. Just 1.15 R. Every one of you here listening is able to size your trades with a 1.15 R. And if you don't, because you're sitting here taking your trade off because you put it on and it went for you 9 ticks, came back to break even, then it goes for you 4 ticks, so you close it, but your stop is still 20 ticks away, you just don't have a chance. You do that enough times and you will be blowing out your account. And that's really the point that I'm trying to make here, that sizing your trade management is really much more important than price, because our selection of price here was really based on a freaking electronic coin. All I did is flip a coin, and then I went to my rhythmic dome and I hit buy at market, sell at market. That's all I did. Okay, so while everybody's willing to pay a lot of money and do a lot to get that great price, if you're not managing your trade right, or sitting through the drawdown, or sitting through the heat, or allowing the trade to work to get you a proper risk factor, it's really hard to overcome the math. And remember, this doesn't include costs, which for a micro is probably for most people is like $1.30 or $1.25 or $1.20 a round turn. So it's a lot relative to the tick size. So this doesn't include that. So at the end of the day, we need to size our trades in a way. So we need to size our trades in a way that we get a profit, a risk factor that is positive, that is greater than 1. And then we start to look at context, and we start to look at setups and market direction and narrative and all of that to then improve our win rate. We start to look at rotations, volatility. You can use ATR if you like, whatever, to then size, make it in the MNQ, make it 46 ticks versus 44 ticks versus 114 ticks for a target. And now we're manipulating price a little bit, and we're fitting our plan to the actual market that we're trading to further improve to create and improve the edge. But at the end of the day, if you don't have your risk factor right, and if you don't allow the trades to play out with the proper risk factor, my point again, for the 16th time since we started talking a half hour ago, my point again is that if your risk factor is poor, it's really hard to overcome the randomness of the outcomes of the market. We need a winner to pay off more than just one loss. We need it to pay off multiple losses if possible, at least bite into more than one loss in addition to our costs and things like that. So that's what I wanted to cover today. I didn't rig this in any way. I had no, it's really easy when you're doing a coin toss to try to wait for it to pull back to get short, or wait for it to pull back to get long, because we want to win, right? But for me, I didn't even look at the dome. I actually reduced the dome to a buy or sell market. I locked in the brackets, and I flipped a coin and I said buy, and I waited for it to show zero position. I flipped it again, hit sell, wait for it to show zero position or whatever, and that's it. And I gathered 30, 30, 30, 30, and then went the next day so that I'm not fighting a trend or whatever, and did 30, 30, 30, 30 again. So I have a sample of 60 for each phase. And to me, that is a reasonable sample size to draw some very broad conclusions, okay? And the conclusion is, the more your risk factor is above 1, the better chance you have, even if you traded randomly, okay? Does that make sense? That's what I wanted to present today. Do we have any questions?
We get a ton of questions.
Awesome.
First question. So if we increase the sample size, can we assume that we keep the same results, or is it just a coincidence? I mean, does the math back scenario 3?
Okay, so I will. So I did this in a live in a live market, right? So there's a market skew, market condition. Is it trending? Is it not? Like if I did this today, I was about to make the wrong statement, because it is still random. Even though it's dropping, I could actually make money on the longs here and there. I'm sure most of you would agree. Unless I make the long, my target 100 points up, I should be able to make something on the pullbacks. But I'm still trading randomly. And so let's remove the results from the market action and go to that risk management, that Monte Carlo spreadsheet that we talked about in the risk management thing. And if you look at that Monte Carlo spreadsheet in that video, I set the risk factor and I hit F9, recalculate, and looked at the equity curve. F9, recalculate, look at the equity curve. F9, F9, F9. And most of you who have watched that video have seen how changing the risk factor completely changes the equity curve, despite the fact that it was running 1,000 trade sample, random outcomes, but more often than not, when the risk factor was positive, was more than 1, the equity curve tended to climb, tended to be higher on the right than the left, the more samples you have. So with that being said, whether you do this in the market or you do it in a spreadsheet that randomizes, the higher the sample size, the more likely that the equity curve would look similar. It may not be the same, but you'll have a better chance at a positive equity curve the more times you run it or the more samples you have than if you just use a 1R or less than 1R. This is what that risk management webinar, if you have not seen it, you have to see it. It's a core piece of what we need to do as traders. But these results here, I decided to do them again. And we used to do these coin toss exercises. We used to have a whole bunch of people do these coin toss exercises, and it's the same thing. In fact, these coin toss results are much more favorable than I'm used to. Those of you who've been around a while.
You there?
Am I here? Am I here?
You dropped out.
Sorry, yeah, my phone rang and it tried to pick
I
up
was
these.
expecting around 33% is what we normally see on these.
Exactly. It's somewhere between 30 and 35% win rate is where we end up, which is about where most people end up in their live trading on a large enough sample size who don't have a plan. Like as a having watched risk on hundreds of accounts and looked at people's performance, it generally, people who are not making money, especially because I look closely at the people who want to close their account and are just done, I go and pull it up and see like what was the issue. Generally, they're like at 35%, at best 40% win rate. The win rate alone doesn't tell us anything. But then within that sample size of 35% or 30%, you have, you know, for the typical person who put in 10 grand, was trading the minis, is the sample that I'm used to, you'll have about a dozen doozies, huge losses there, like where they have basically risked, you know, 20, 30% of their account, then they grind it back, and then they blow up again. And the day they call and say, close my account, send me the balance, generally that's a day where they've again lost a huge portion of their account and they're done. They're emotionally done. Their edge is actually there. They're just not executing it. That's the most common problem that I see. And on a random coin toss, you have about the same win percent. Imagine that. So I could have taken that person's account, put it on a computer that took random prices for the same amount of, probably for many more trades, because computer is not going to sit here and hold on to a bad trade beyond its stop value. So it's going to give me more samples. But at the end of the day, that random computer is now trading at or better than a typical online trader coming in and kind of doing their thing and allowing a few blow up days and things like that. We're all familiar with that. But the bottom line is they still didn't size their trade management properly. The risk factor is still not proper, so they cannot overcome the randomness of the market. Okay. What other questions?
In your opinion, what is a reasonable target percentage of scale out achieved and a reasonable percentage of full stop in actual practice?
I have no idea. And the reason I say I have no idea, because it just, the percent of what, it's such a, that is almost like what we call in science or in engineering a multivariate equation. It's like a 1x plus 2y plus the square root of 5z. You have three things that you can't solve that equation. That's what we have here. It's a percent of what. It's really hard to say. So let's set that aside and just look at the facts. The facts are, I have X account size. I'm trading a $2,500 account in the micros. That's a good sized account, reasonably sized account for micros. It's the equivalent of 25,000 in the minis, okay? Good size account. Okay, and I'm looking at the market in about a 1 minute time frame. Cool. Okay, within that 1 minute time frame, we have rotations that are in the 3.5 to 4 point range. That's the volatility. That's an indirect measurement of the volatility of the rotations that I'm going to be participating in. Great. So that's, 4 times 5, that's $20 per contract that I'm risking. Okay, so that's my risk. Okay, and I need to size it just outside of that range. So maybe call it 5. I'm risking $5.50, $5.50 per contract on a $2,500 account. Okay, how many of those can I take in a day so that I have reasonable risk? Well, you don't want to trade a one lot, you want to trade a two lot. So that's $11 on, let's whip out the calculator here, $11 divided by 2,500. So you're risking 0.0044, right? So you're risking 0.44% per trade. Very reasonable, very reasonable. That's great. That's a well-capitalized account, right? Okay, so now I've got that risk at 4.5 points is my risk. Okay, that's $5.50. Now, what can I do on the upside given what I'm looking at in the market, given the trades that I'm looking at? Okay, I want to at least get 5 points net, right? Beat that 4.5 by a little bit, minimum. I want to get 5 points net. But if I look more closely at the setups that I have, at the way I'm looking at the market, at my Bollinger breakout or Keltner breakout or whatever it is, whatever you're trading, I believe I should be able to reasonably get 5 points to 6 points. Cool. So I'm sizing a trade for 4.5 points of risk. I'm going to scale out at 4.25 points scale. Excuse me, I need to clear my throat. I need to scale out ahead of one rotation. Let's call it 4.25 points. And then I need to then now get on the second one better than 5 points. So on my second contract, I need to get approximately 5.25 points. Can I do that? And that's what you have to look at. Okay, what do I need to do to get that? And now I have on a very basic level, I have a program that has an edge. And layered on that edge, I have good money management because I've sized it so that I'm risking 0.44% of my account. So to be stop limit down on the day, I'm willing to risk, say, 2% of my account. Okay, if I'm risking 2% of my account and I'm risking 0.44 for each trade, and that 0.44 becomes bigger and bigger the more you eat into the 2,500, it's kind of like a moving target. But generally, I can take 4 trades on the day in a row that are losses before I have to stop. That's reasonable. That's the beauty of these micros, right? That's reasonable. I've got 4 chances really of 4 losses in a row. But if I don't take 4 losses in a row, I can then have a 5th trade, and I can have a 6th trade, and a 7th, and an 8th, and a 9th. And the more trades I have in a day, the closer I come to my true edge and realizing the profit potential of my plan. And that's how it works, folks. It's just, you take these pieces and you say, okay, I need to then go into my charts and figure out how I can make sure I get 4.25 points on the majority of my trades and 5.25 to 5.5 points on a target. Can I do that? And then now I have to make sure I pass on trades that I don't see would give me that. Those trades are not valid. Okay, and so you're almost like being a detective, a murder mystery detective, like you're narrowing the suspects to the one that now you can be sure of, and that's your setup. That's when you actually act. That's when you go and make the arrest with confidence or take the trade with confidence, and you've done all this homework to the point that there's just no doubt the execution is perfect because what the heck else is there to do? So to the question about reasonable target percent versus full stop percent, it's hard. What percent of what? I can't answer that. But in practical terms, looking at the product you're trading, looking at your account size and so on, you can really box in what you need to take and then validate it by just back testing or clicking through a chart bar by bar and seeing, okay, what do I need to see? If I look for an impulse pullback and take the break of the bar, how likely is it for me to get a 4.25 point scale out? How likely is it to go 5.5 points in my direction? Oh, very likely. So this is the setup I'm going to take. Boom, right? And then the randomness will happen, but the randomness is somewhat neutralized by my trade management because I'm going to get more on my wins than my losses.
If your win rate is less than 50%, then are you just doubling your losses by trading 2 contracts versus 1?
No, because my win rate doesn't matter when I have 2 contracts because I go from, I mean, the win rate matters always, but I go from just, if I just scale out, I have a 0.9 risk factor versus 0 versus nothing, right? If I have a 1 lot, I either get my target or I'm dead. It's my target or my stop. But a 2 lot, I can secure 0.9 of the risk. I basically have just funded the trade with 9 more ticks. That's all I've done. The scale out is basically a credit towards the risk on the trade. That's all it is. So essentially, it's the equivalent of having a 19 tick stop, let's say. And so it really doesn't. So if you have, if say, let's say I have a 40% win rate, but I can go and offset that with a risk factor that gives me, you know, I'll guess maybe 1.25, 1.28 risk factor. And this assumes that you don't have a high full stop out, meaning you get in, you get stopped out for 2 contracts a lot. Then my loss rate could be high-ish, but I make up for it when I do get those wins. So if I'm at 40% win rate, I do get the 60%. That 60% is paying for, say, 70% of my losses, which overcomes the 40% win rate, right? So you have to size your stop. It's really important in that situation, in every situation, to size a stop reasonably. This is why it was one of the most maddening things when people will just come to futures and they watch some order flow trader who's selling all kinds of courses and stuff, and they're like, "Oh, I never take more than I don't take more than a four tick loss." Oof. A 4 tick loss means you either have just an astronomical loss percent because you're hitting that 4 tick a lot in the ES, or you have a 95% accuracy win rate to overcome such a small loss. Go the opposite way. How's my win percent going to look if I have a 60-point loss limit or stop loss, 60-point stop loss, and I have a 4 tick target? Well, dang, I probably am running a win percent of 94%. But boy, how many 4 tick gains will it take for me to make up a 60-point loss? 60 plus costs. So the win rate is kind of it's not giving you the full information. That's why we use expectancy, because expectancy is also looking at the value of that win and loss in addition to how often it happens. So you have to mold those together, but let's not get too complicated here. It's about account size. It's about how much you're risking per trade. It's about for that risk, what should I get when I'm correct, and does that make up for the risk, and is that reasonable within the time frame, rotations, volatility of the market that I'm trading? This is kind of the dance we have to make, and these variables change all the time. Like maybe tomorrow we'll have another 3-point selling day, Well, 4.5 points now is no longer reasonable as a stop. It needs to be 8, which means I need to get a net 10 points when I'm correct. So now I have a 7.5 point scale out, and I have an 11.5 or 12 point target. Can I get those in that environment? I should be able to if I'm right. But my overall win percent stays the same. My expectancy should stay the same, but I've compensated for, you see, it's like these variables that you have to pull and push depending on the factors mentioned.
Someone would like to see again the win weight and the expectancy of phase 3 versus phase 4.
The expectancy of phase 3 versus phase 4. So expectancy is greater in phase 3 than phase 4, simply because there's a scale out. Phase 4
And
had a higher
win weight?
profit factor. I had a higher risk factor. And then the win rate, I did not break that out. So let's look at the win rate. The win rate on 3 is 48%. The win rate on 4 is 42%. That's what it
Okay.
comes out at.
So do you recommend having a very static or blind trade management to start to first prove profitable before we try to start being dynamic with adjustments or active trade management?
Okay. Let's answer that with a question. To everybody still listening, what do you think? Do you think it's better to have static trade management versus dynamic? What do you guys think? Come on.
Starting out, yes.
That's
Static,
static. Yes.
static. Depends on your emotions. Static, static. And we have 1, 2 dynamic, 3 dynamics. And now all the dynamics come in.
And then
So it's
we
split.
okay. Static, again, static is you set brackets in your platform, or you always trade the same exact stop loss, scale out, target. Always the same. Dynamic is, depends. For this particular trade, I might move my stop to break even sooner. I might move my target a little tighter. I might expand it. I might do all these things. That's dynamic. Dynamic is more, I'll just respond to what the market is telling me, versus static is like, come hell or high water, my stop is 4.5 points, my scale out's 4.25 points, and my exit is 6 points or 5.5 points. And my answer
You have to
to that,
realize we get smarter once we get into the trade. So
yeah,
dynamic is obviously better.
well, yeah, that's sarcasm, by the way. That's sarcasm, folks. Here's what I've recommended to people who are still seeing a negative expectancy. You want to make that as static as possible. You want your trade management to be static, because when you don't make it static, what happens is, because it's really all about your performance metrics. It's about your journal, your trade log, right? And if you make it variable, then what happens is you're managing your entry, which is random. You're managing a market's condition, which is random. And then now you're adding a layer of random management. And there's no way to troubleshoot whether your entries are the problem, whether the market is the problem, in other words, you're not compensating for volatility or whatever, or if it's your trade management that's a problem. So we want to take a multivariate equation, as I talked about, too many unknowns, it's unsolvable, to one that has 2 variables, price and market condition. We cannot control market condition, so boom, it's down the price. If we keep our trade management stable, then we know, okay, something's wrong with my setups or my execution. But if you change all these things, it's too big. You cannot solve this puzzle. So until you are not trading emotionally, or you're not attached to these outcomes, if you are trading emotionally, you kind of don't have a choice than to go to a static trade management scheme. and to make sure that every day you're coming in and verifying that your trade management scheme is appropriate for the current market. And sometimes you come in and it's appropriate, but then the market's in a 5-point range, and that's just not a day to trade. So you take your loss and you stop and you're done. Okay, so for me, my answer to that is you want to keep it static. Keep it static to start. Being dynamic means you are completely unfazed by the market action and by your emotions. You will absolutely and positively do the right thing when it's called for. And most people, maybe they think they're there, most people are not. So just use brackets. Heck, I'm trading the NQ, been trading for 20 years, and I'm using fixed brackets. I'm using the bracket system within Rhythmix Dome. I'm not even doing it on Bookmap. It's because it's too fast. It's too like I get in and the market just disappears. It's the smart thing to do. Just make it fixed and focus on the market, focus on entries, and let the trade do what it does. Okay, and that's what the coin toss exercise teaches us. We're gonna have to wrap up here. I hope I've answered everybody's questions. We've gone an hour. We need to cut it off here. Okay.
There are questions outstanding. Please feel free to submit them for this upcoming Tuesday's AMA, and we can tackle the outstanding questions there. One last one, people have asked if possible for you to share any of these spreadsheets with the video so they can run this themselves.
Sure, I'll make this spreadsheet available. Absolutely. Thanks a lot, and thanks Yoda for moderating. Take care, everyone. Hope you picked something up today. Cheers.